make our way back in. We're getting there. You guys have been troopers. Lots of important information to come. First of all, I want to remind you that after this session, we have a networking event next door for an hour or so. So again, really important. I love to hear all of you making conversations in between meetings and at lunch and forming collaborations and getting to know each other. So I really encourage you to come and join that networking event. So we're going to finish up the day with this fireside chat with two members of our Focused Ultrasound Foundation staff. We have Patrick Edelman and Randy Castleman, and they're going to be having this chat with Bradley Horowitz, the Vice President of Google, and Michael Marquez, the founding partner at Murado Ventures. And we really look forward to hearing your conversations. So here you go.
Ready for us? All right. Well, welcome back, everybody. We're excited to begin the fireside chat, last panel of the day. First off, I'd like to introduce myself. I'm Randy Castleman. I'm with the FUS Partners Program. The Partners Program, for those of you who don't know about it, is in the business of acting as a bridge, really, between the emerging and the established companies in the ecosystem and the capital markets. Our job really is to highlight, share best practices, to really grow the industrial ecosystem as best we can. Essentially, it's a free iBanking and free management consulting program from the foundation to the industry. And that's what Patrick and I do with Emily White and Philip Keevel. We'll be around throughout the symposium, so for those of you who have questions after our panel, I encourage you to find us. My background personally is about 22 years in investing in emerging technologies as a GP of a venture firm, also allocating into venture capital for a large multifamily office. And I have a practice as well where I work with large family offices on their fund investing and their direct investing. And so, like Patrick, who has a financial services background, I bring some of that capital markets wisdom, I hope, and an enthusiasm for what is being done in focused ultrasound and the entrepreneurs who bring it to us. So with that, I'll turn it over to Patrick and we'll get underway.
So my name's Patrick Edelman, for those that have never met me before. Quick background on me: I spent most of the prior 20 plus years at BlackRock, helping lead a large pool of their investments, primarily focused on healthcare. For me, what brought me to Focused Ultrasound was my father's own diagnosis with essential tremors and seeing a better alternative for it and for many other diseases that treated patients quicker, safer, and most importantly, more comfortably. And so that's ultimately what brought me here and to Neil and to partner with Emily and Randy on what we do with FUS Partners. So I'm pleased today to introduce two gentlemen who I call my business partners away from FUS, but also two dear friends, Bradley Horowitz at Google and Michael Marquez of Murado Ventures. I've had the privilege of knowing both of them, both Bradley and Michael, for a while, but their history goes back even further when they first crossed paths at Yahoo, where they built the in-house incubator called Brickhouse. From there, Bradley went on to Google, where he'd lead many of the products that we all know and love, I hope. If not, you can complain to him, like Docs and Mail. A few years back, Bradley expressed an interest to try something new and was tasked with the effort to lead the in-house incubator of Google dubbed Area 120. Michael, post-Yahoo, led business development at CBS, and from there built both Code Advisors, a boutique advisory shop, as well as Murado Ventures, an early-stage venture fund, to lead the an early-stage venture fund focused on deep tech that is in the process of raising its fourth fund now. So why are we here? One thing at the core of business formation is that there's a similar DNA that forms the basis of any good idea, be it capital, people, or just plain initiative that helps accelerate the beloved flywheel of momentum. So we thought it'd be good to bring in two individuals, in Bradley and Michael, that have seen idea genesis and company formation countless times across industries to discuss what's at the root of it all. So Michael, Bradley, thank you for your time, and good to see you up on the screen. I'll kick off the first question, and probably a pretty loaded one just to start off. Having served in incubator roles within two very large firms, one thing that we often run into here is any idea begins with a couple people sitting in a lab or in an office or in a classroom coming up with an idea. And so as you guys have seen this, and for every one idea you guys think passes, 999 of them don't. How do you differentiate between an idea and a viable opportunity to create and grow a high impact business. So I don't know which one of you wants to go first, maybe Bradley?
Yeah, sure. First of all, thank you, Patrick and Randy, and thank you for having us today. It's a real honor to be with you. Ideas are cheap, and almost everyone in any organization is going to be filled with ideas about things we could be doing or could be doing differently. And so ideas are important. All great companies, all great startups are born from a great idea. But what is a much rarer commodity is an entrepreneur or set of entrepreneurs who can really execute against that idea. And so in my experience, and this is borne true in my own angel investing as well, I'm really looking for an entrepreneur. And oftentimes the initial idea is really sort of a living resume, sort of a work product of their thought process. So it's not that ideas aren't important or that we don't take them seriously, but often in the life of any startup that's going to be a 10, 14-year journey, there's going to be many, many pivots. The technology will change, the outside world will change, we're going to have to adapt. So it's very rare in business that the business plan will be the playbook that takes you forward for a decade. You're going to need someone who's able to pivot and sort of dynamically adapt to the changing business environment. And so we're really looking for a certain kind of entrepreneur, someone who is really passionate about the idea, who is sober about the sort of challenges ahead, and incredibly committed in spite of those challenges, and sometimes because of those challenges. And when you find entrepreneurs like that, I mean, these are the easy checks to write. And many of my colleagues at Google, we sort of have a tacit understanding, which is if ever, God forbid, you should leave Google and go do a startup, please let me be the first check to whatever you're doing. And I don't care what they're doing. I don't care if they're going to do something in climate or in healthcare or in consumer or enterprise. I know that they're the kind of person who will figure it out or make me proud trying. Again, most of these things are long odds, and we sort of understand that going in, but there's a certain prototypical kind of person who I would bet on again and again. And again, my own personal experience has borne that out. Mike, I'm sure you have something to add to that.
Yeah, no, I'll just add, I mean, it definitely is, at the early stages, I'd say 95 to 98% of focus on the person and the individual, as Bradley mentioned. As far as the idea itself, again, there's thousands of ideas out there, thousands that have never, come to fruition from entrepreneurs that, had no kind of execution capability to get it off the ground to anything more than an idea. But in assessing the idea, again, it depends on the context of how you're assessing it. When Bradley and I were doing our in-house incubator at Yahoo, it was really looking at, how do we keep the great talent that Yahoo had attracted into the business focused on opportunities that could continue to grow and expand the platform inside Yahoo. So that was kind of the first, filter on the idea was, is it aligned with that? When we're investing our own money, either personally or through the venture funds that Bradley, Patrick, and I have worked together on, it's really more of an assessment of, is this a venture idea? And that actually has kind of a different connotation than, could this be a good business? Because at the end of the day, you really are looking for, that 10x, 100x return. And does this idea have the market size, the growth, et cetera? So in evaluating the idea, the other 2% or 5% goes into that, at the early stages as well. And the one thing that I'd say is that what I really love with entrepreneurs is where they're scratching their own itch, where they come from a place of context of understanding, what that market opportunity is, whether it's maybe they've had exposure to the difficulties in building solutions like this or the opportunities that it can create, but something that provides it a little bit more context. And then starting from there at the early stage, it's really a bet on the person and can they continue to build the culture, build the team, and continue to weather all of the, the onslaught of reasons for why the company will fail? Do they have the constitution to work through all of that?
Yeah, I mean, these are both great observations, and I particularly like the idea of, is it a venture idea versus it merely a good business? This begs the question of the various stages of a business's development and the different types of capital, all of which, are risk capital, but which have different risk profiles. And maybe one or both of you could walk us through, that sort of spectrum from personal money as an angel up through, institutionally managed capital up through later stages of growth and even crossover. Those are very, very different types of investing with very, very different types of investors. And I know that when we work with our focused ultrasound therapeutics companies, sometimes that's a lot to take in. This idea that you need to think ahead about your financing trajectory, and there might be different types of people at the table for different stages. I don't know what your experiences are with that.
Yeah, no, maybe I'll go first, Bradley, and then you can jump in as well. And it's evolving, through the last, kind of years as well. Kind of what was before, a cottage industry of angel investors has given rise to pre-seed funds and super angel funds and seed stage funds, et cetera. And so, kind of you have all of this that's evolving over time. But as far as the stages, you're exactly right. At each stage, there's kind of a different, kind of context for that fundraising. It starts with, as Bradley said, when you're working with individuals that are incredibly talented at what they can do, you're behind them and saying, listen, when you think of your next opportunity, I'm there to support you, almost just as a support for that person, regardless of the idea, right? That's that angel, kind of friends and family round, right? They know you're capable. They know that you're, ambitious. They know that, whatever you put yourself to, high likelihood that it's going to succeed. But they're not really, doing a deep evaluation of the idea. There obviously isn't enough historical track record on the company to do any deep, diligence around the metrics of the company. And so it really is, kind of funding the person and the idea at that early stage. Then as you move into kind of the pre-seed and seed stage, you start to look more at the evolution of the product and what that, and how you can diligence that. So you look at, maybe it's a wireframe, or maybe it's an actual demo of the product that you can actually start to envision, how would a consumer or a business use this service. And so then from there, again, check sizes are small because the risk is a lot higher that the company will fail, but you do need the resources to continue to build it out, and you're evaluating it based on the idea of what this could become. Then as you start to move into, kind of the seed and Series A and Series B and beyond, then you start to get into more company formation. Check sizes get larger because now you're hiring more people, you're investing in more infrastructure, et cetera. And now you have a broader set of metrics to diligence. If the company has a first customer, if the company has revenue, if the company has, expenses, et cetera, you can start to evaluate that. And as you move further and further down that chain into Series A, Series B, Series C, et cetera, it starts to turn into more of throwing fuel on the fire. And so what are you doing to allow for those companies to have the most seamless access to those resources that they need? And at the later stages, it does become a lot more, capital that's the big focus here. And obviously at that stage, you can do a lot more diligence around the company, around the market, et cetera. And so at every one of those levels, the scrutiny of diligence should get harder and deeper because there is more things that you can evaluate on, and the dollar sizes of those investment rounds increase correspondingly as well.
Indeed. Bradley, any other thoughts on that?
Yeah, Mike, I think, said it very, very well. And my own personal experience is really at the angel level. And the thing that I will add there is usually people are taking my check, which honestly won't get them very far. The checks we write are typically very, very small. But they're taking it from myself and my wife because we have something to offer beyond the capital. And that can be know-how, it can be Rolodex, it can be introductions to other investors. I think especially in those early stages, people are looking for assistance in sort of bootstrapping this idea into the next phase of viability. And that can also be true as they get through a Series B and Series C. They're looking for board members who sort of are going to, help them get the hygiene that's required, hire the senior executive staff, all of those kinds of things. So that kind of assistance changes and goes through phase shifts as companies march through this progression. But my own experience is really in that, so you want to start a company discussion and all that entails in the first 6 months of that journey.
Right. Great, thanks.
So let me just ask a question. In terms of company formation, you think about those initial angel investors and those initial kind of first few rounds. How should investors think about how much percentage of the company they should be willing to kind of seed and sacrifice to that early stage? And can you kind of walk and step through? Is there kind of a benchmark? Is 20% kind of what an A round should look like? And how much of economics should you be willing to kind of give up out there to investors?
Well, Mike is much more expert in this than I am, but I will say one thing I've observed is it's incredibly macro dependent. And, 6, maybe 9 months ago, a couple of kids from Stanford could make a few slides, walk in and have an oversubscribed deal at a $50 million valuation based on nothing more than their degrees and a slide deck. And, we called those times frothy. That was sort of peak froth. And, things have really cooled off. And so while it's sort of a trickle down effect from the public markets down to the late stage companies, even at the seed stage, valuations have been brought back down to earth. And so, as a fraction of the company, what percent should you get for an early angel investment? Obviously the risk is higher, and so you should be rewarded for taking on that early risk. But we've seen scale factor swings even over the last year in what one should expect based on the overall market conditions.
Yeah, Mike, maybe I was just going to say, maybe you could take the angle here of, I know there's that kind of cone or that funnel that you and I have looked at many times, just kind of talking about what the numbers look like in terms of from seed and then to kind of late stage and IPO, just exactly what that looks like for people just to get a grasp.
Sure. Maybe just kind of one quick thing just to build off of Bradley's point as well is that, when you have that, the angel round is really, as I said before, it's, I'd say it's probably the least structured out of all of the rounds. And so that one you might have, you might do it as a convertible note that basically means that you're not really giving up any equity with that note. It's a debt instrument, but in that next round of financing, the pre-seed or the seed, is where that rolls in together. And I would say historically, in the first 2 rounds of funding, you're giving up about 20%. That's what it's been historically. As Bradley mentioned, things got a little bit frothy in the last couple of years here, and that was more like 5 to 10%, which was on the much, much lower side. And then as the company scales and valuations become much larger, then in those later rounds, you're giving up, kind of anywhere from maybe 1% or 5% or something like that down the road. But to answer your question more specifically, Patrick, there, if you look at the, kind of just from the, kind of a Series A round to call it a Series C or even a unicorn, from seed to Series A, the stats are that, about half of those companies that raise a seed won't raise their Series A. And then from A to B, it's about 30% that are able to raise from there, about 15% at C, about 9% at D, and about 3% at E or unicorn at 1%. So at seed stage, you're looking at, the likelihood that you get to a unicorn or, kind of Series C, which is assuming a much larger company, is somewhere in the order of magnitude of, kind of 1%. which is incredibly low. And the risk there is very high. And so that's the reason why, if you look at, the biggest ownership dilution or the biggest ownership pieces that investors have, they're at the early stages, because the risk reward has to be commensurate, right? If you're only getting 1% or 2% of a company when you invest at seed, by the time that if it does make it through all these other gates, you will have very little return to make it worth your while. And so again, a lot of this has to do with where is the biggest risk being eliminated from these companies. And you see that, kind of post Series B into Series C is when those drop-offs start to normalize a little bit. And so that's why you see less and less dilution as you, progress further in the life cycle of the company.
That's so interesting. It just really makes me think about the last 10, 12 months. And I think Bradley was mentioning this idea of the sort of signal from the public markets that, as the stock market got wobbly and as people began to wonder whether the valuations of the last several years were viable. 15 years ago, it took a long, long time for that kind of information to make its way from the frothy public markets down into the, Series C, Series B, God forbid, Series A. It feels to me like that time has shortened considerably. And I have a theory about why, but I'm curious if you've noticed the same thing, and if you think that short time period for that signal from the public markets to come down into the earliest stages of innovation is here to stay, or is just an unwinding of a kooky time?
I think that, I think, and Bradley can chime in with his thoughts as well, I think a lot of this has to do, we see this throughout a whole host of industries, just the speed of information flowing. And we're seeing this in the venture industry as well. With that .com, bust that I lived through, it took a while for the public markets, the private markets, to reconcile the valuations that they had and the hopes and the dreams that they had, kind of 6 months, a year prior to that, when the public markets were completely destroyed in the technology space. Here, we saw this happen so much faster, and I think it's because the information that was flowing from, either whether it be crossover investors that were going a little bit earlier, so they're transmitting the information faster, in the, speed that now you have Twitter and you've got all these other, fast, kind of communication channels that are getting that information out much faster, and companies reacting to this so much quicker than we had in the past. I think that the one thing that I'll say is that I don't think cycles are gone. I don't think that this is now, early stage companies are forever going to be, as cheap or cheaper than what we're seeing now. I think what we're going to see is the speed of information flow. And so just the same way these things drop, they're going to come back up again, and then they're going to drop again. But I think that what we're seeing is a compressing of, the periods of time of information lag between those cycles.
The only thing I would add is that I think there is some aspect of irrationality and emotion at play. It's hard to read the newspaper and then, fold it up and be an optimistic investor, given all the uncertainty in the world and the, sort of doom and gloom parading on us. So I know as an angel investor, I have to pinch myself and remind myself that the outcomes are a decade away for most of the companies. For the 1% that will make it through the journey that Mike described, the world will look very different, hopefully, in a decade. And so I do think it's a good time. This is the buy low part of buy low, sell high. And yet it's hard not to feel impacted by sort of the macro doom and gloom that we're all experiencing on a daily basis. And certainly as you march through that pipeline, obviously valuations on public market stocks are what they are. And now for companies that are in mezzanine situations, it's also hard for them to get the funding. I recently was in a meeting where the conclusion with the company was, everything is working. There's light at the end of the tunnel. Unfortunately, we only have cash to get halfway through the tunnel. And this is not an uncommon story right now, that later stage companies are needing to create an environment where it's default alive, meaning if nothing changes and they can't get funding, they need to figure out a way to hunker down and make it through this funding lull and crisis that we're having right now. Which again, I'm confident will pass. This is a moment in time, and those of us old enough to have been doing this for a while have seen cycles like this come and go before. But it does dramatically change the trajectory of a company, and you cannot put blinders on. One must be sensitive to the cash burn, and you want to sort of structure your company to survive a moment like this.
One more on this topic. I think it's interesting, this notion of dry powder amongst venture funds, which is basically the idea that a venture fund, raises its fund and then deploys it over 10, 12 plus years. And for those venture funds that raised very recently, many of them came back to market quicker. They came back for more money. There's a fair amount of undeployed capital, at least amongst the institutional investors. And I'm just curious if you feel like that is going to prop up some of the valuations we've seen over the last several years, or whether that'll work itself out of the system pretty quickly.
I think two sides of that. One, it will keep valuations propped up a little bit higher, right? I mean, if you have, especially if this is money that's in the same fund, right? If this is money that you've raised from another fund, that gets a little bit harder to try to prop up, previous investments. But to the extent that, this is part of the bias issue with a lot of venture investors, right? To Bradley's point, you don't have enough to get all the way through the tunnel, but you were the one that, were there at the early days and you saw, the car getting built and, you're super excited about someday getting through that tunnel. You're halfway through it, just a little bit more money will help it to get that, kind of to get it through the other side. And, let's not affect the valuation because that's going to affect, recruiting or momentum or et cetera. So let's just, kind of put a little bit more money in here to get it to the other side of the tunnel. Sometimes that'll work and sometimes that won't work. And so it'll kind of prop up that valuation that when you get closer and closer, you realize that you're not going to get there, where it'll drop, dramatically if you're not there to support it. So I think there will be some part of that. I also do think that there is a large number, especially raised into new funds, that you can't kind of take out the emotional side of, kind of, as Bradley said, what's going on in the world. And as much as the valuations have come down, pretty dramatically on a lot of companies that are raising funds right now, you also can't help but think, like, is it going to get worse? Am I going to be the investor that, thought that I was getting a great deal at a $50 million valuation, but then lo and behold, 2 months later, it's now a $30 million valuation. And so there is still a little bit of waiting to see, kind of where this all, comes together. At the end of the day, these are venture investors, so they are looking for, ways to put the money to work, and they are optimistic of the, changes that of the impacts that will be done here. But at the same time, I still think that there is a little bit of a waiting out period of, you don't want to be the first one to jump into the pool only to find out that, there's no water there and you smack your head on the bottom.
If we can tilt back a little bit just to kind of just talking about, the incubation side of all this, and are there consistent signs that you guys see before they actually happen? Are there red flags? And Bradley, maybe I ask you this, given the scale of what Google does, but are there consistent red flags that you identify that sometimes necessarily just aren't business related that, that we can understand a little bit better?
Yeah, this is, I think, a real symptom at Google, but I also think it's an ailment that afflicts any technical founder or scientific founder, and that's that people become infatuated with hard technical problems. I'm constantly reminding people that we're not trying to win a Turing Award or a Nobel Prize here. We're trying to build a business. Now, oftentimes a proprietary technical moat is a great way to build a business. But again, when you're dealing with people who are extremely technical, they'll tend to over-optimize and sort of, build systems that are scaling to handle billions of users before we're even sure if, there's dozens of users for that system. And so I think one thing that is a red flag is really premature optimization. And there's been a lot of talk about this in the Valley. around sort of faking it until you make it. Famously, the Airbnb founders, before they had a matching algorithm, they were sort of, man behind the curtain that was hand matching hosts and guests, just to prove out the viability of the system before they invested in actually, a more robust and more algorithmic approach to what they were doing. And so that's one thing I see a lot of at Google is, and this also speaks to Mike's concept of not every idea is a venture backable idea, but people solving problems where you basically ask them, even if you did, win the Nobel Prize and go through all the difficulty in the engineering, scaling this, et cetera, to what end? Let's look 10 years from now and actually ask, if you actually solve this problem, what does it matter in terms of its market impact and commercial viability, et cetera? And way too many folks are sort of charging down paths that don't have a good answer to that question. And so that's one thing I'm always looking for. The more general question of like, how do you know when it's working is really one of the hardest that we confront on a daily basis, whether that's in investing or even in the corporate context of deciding to continue funding an area of research or a product. There's many examples of products that took a long time to play out. And I'll invoke this example. Patrick and Mike knew it was coming because I have to share this story almost every time I get to a microphone. But my greatest investment was actually my first investment. And I had a friend who was sleeping on my couch and going through a bit of a hard time, and asked if I would like to invest in his idea, which I thought was a terrible idea. It was a 2.5D video game that was sort of a cross between World of Warcraft and what today would be Roblox, something like that. And I'm not a gamer, I don't know much about gaming, but I had a lot of faith in this friend, and I also appreciated the moment he was in. So I invested the smallest amount I thought would not be an insult. And for 5 years, I sort of was relieved that I didn't invest a penny more. But in the meantime, there was a venture capitalist at Excel Ventures who was smarter than I was, who kept shoveling money at this guy and saying, keep going, keep going. Even as the game was not coming together, even as it didn't pick up users, they just had a lot of faith in this guy. And then in year 5, my friend called it. He basically said, the game isn't working, and we're going to try one last Hail Mary. And he retired the game, laid off about half the staff. But to build the video game, they had built this communication system so that engineers in Vancouver and San Francisco and Tokyo could talk to each other. And that tool, he rebranded as Slack. And it became the fastest growing enterprise software product in history and was eventually sold to Salesforce for $27 billion. And there's many lessons in this story. It gets back to my first comments about bet on the person, not on the idea. I never saw a business plan for Slack. He didn't have a business plan for Slack. But it also speaks to when is it time to pack it up and go home? And a lesser venture capitalist, and I take no credit for this because really I made that initial investment but didn't maintain my pro rata through his various phases. A lesser venture capitalist would have basically called it after 18 months and go, well, that didn't work, and sent Stuart home. But Andrew Bracha at Excel had faith in Stuart and faith in the process that he would find something. And so I'm greatly relieved that he had a very long leash and lots of fuel to sort of take him on this walkabout that eventually led to the product we know today as Slack.
Bradley's humble brag, but I do love that story. We've got about 10 minutes left. Brandon and I have questions, but I don't know if anybody in the audience has any questions. There's a microphone up, but if not, we can kind of continue. Sure. Do you want to step?
One of the questions that reminds me of, especially in med tech, it isn't quite the same as when you're building a food delivery app. There's a lot of regulatory things to consider, and there's a certain amount of planning, staging, and gating that one just has to do to be responsible with the capital that you're investing. I guess I wanted to generalize a bit. You know, there's this idea of trying to time your fundraising with your value inflection points, and the idea that you probably don't want to raise, just before you have a value inflection point. But it's really hard, to your point of when do you know? When do you know? And I'm just curious if there's some general lessons that the entrepreneurs in the room can take about that sort of breaking down a financing trajectory so that it makes sense relative to the value creation points in your own business plan, if that makes sense.
Yeah, I'll chime in here. First of all, I'd say just, like the public stock market timing, like it's incredibly hard to time. I've seen so many companies that, to your point, have tried to, kind of delay a financing because they think that there is an inflection point, but then that inflection point doesn't come, and then you have less money to actually execute against. And here you are, not with having raised less money, but maybe raised no money at all because you didn't get the milestones that you needed to in order to raise. It's kind of similar to, I do a lot of M&A advisory as well, and there's so many companies that try to build themselves to be acquired by XYZ company. And again, it's the same thing there. You don't know timing-wise, you don't know product feature set-wise, et cetera, if you're going to be a perfect fit for that. And if you kind of put all your eggs in that basket, it's incredibly risky, not to mention, how incredibly risky a startup is to begin with. And so I would say incredibly hard to do. My advice to a number of entrepreneurs is to don't get greedy with dilution. If you think that there is, an inflection point of where you can raise money at a better valuation down the road, and you don't need all that money right now, then raise some of it now, and you can raise some of it, the much larger portions of it later. But I've seen too many companies try to over-optimize for this and get it wrong on the short end of this, then get it right on the other side of this. Because if you think about the differences between getting it right and getting it wrong, if you get this wrong, then your company is out of business. If you get this, kind of on the delaying it, if you get this wrong on taking too much dilution, then maybe you gave 5% or 10% up too much too early. It didn't ruin your company, but you now still have, 80, 90% left of a very healthy, fast-growing business. And so, again, what I would do is figure out at each stage the capital that you need, give yourself a buffer on that capital, and, probably a time and a half type of thing, so that you're never at a stage of where you're desperately trying to raise money, which is the worst possible time to raise. And don't get too greedy on the dilution side of it, because it always makes up for it with a successful company.
I will add just one comment. Paul Graham, the founder of Y Combinator, said that startups fail for one reason and one reason only, which is they run out of money. Where there's a dollar, there's hope. You can pivot, you can reinvent yourself. We've heard countless examples of that. And I tell entrepreneurs, the fundraising process is like jumping from lily pad to lily pad. And really the only thing you need to do with your seed dollars is get to the Series A. And the only thing the Series A is good for is getting to Series B until eventually you have a viable, ongoing, sustainable company for the ages. And it's easy to forget that because, you do need to sort of build for the ages, but you need to develop a narrative such that when you're out there fundraising for the next round, you've got the irresistible, irrefutable evidence that you're a great investment for the investors you're talking to. So really that notion of sort of skipping from round to round is really important for an entrepreneur to keep in mind, that even as they're aiming for their North Star and to achieve the vision of the company, they've got to create narratives that make for a really compelling story. And the one other thing I'd say is, unlike public market investing, there is something that the entrepreneur can control, which we've referred to already, which is burn. And so, there's a lot outside of one's control, but those things within your control become even more important to really optimize against. And every company I know right now is going through an exercise to figure out how do we get the most mileage out of the cash we do have to take us to that next irresistible funding point.
So I'll try and end on an optimistic note. because the world's tough right now, right? I think everybody looks at the markets every single day, the volatility, what the broader markets have done. We've seen kind of venture capitalists tightening. Bradley, Michael, you guys have both seen multiple cycles. Kind of send us out here on a positive note about, business formation coming out of kind of downturns, et cetera. How do you feel about the market right now in general and the opportunity set that kind of exists more broadly?
I mean, I'll go first, and Bradley can really kind of send us off on a really high note. But I'm long-term bullish. I mean, if you think about the innovation that's being created today and the technologies and the pace of technology creation, but more importantly, what I get excited about is the pace of technology adoption. Back in 1995, when I was first starting this, you had, kind of an audience that was incredibly skeptical of the impact that technology could have and their comfort level with it. In today's days and age, you look at, generations that are growing up, if not 100% in the digital space, 95 or 90% in the digital space. And so you get an audience that is much more comfortable in adapting to and absorbing the technology changes that we're seeing here. So I think that, we've been saying this for, 30 plus years, but it feels like we're in inning one of this technology revolution. And I still am incredibly excited about that. Not to mention the fact that, as we mentioned before, the entry prices for an investor coming into this specific time frame that we're looking at, I think is incredibly exciting. And if you look at, these downturns, whether it was 2008 that produced Snowflake or, to the .com bust that produced Google, like there are some incredibly great companies that are going to come out of this, and at prices that entry prices for investors that are going to be mind-boggling from this, kind of 2-3 years down the road once it's very clear, kind of what these companies are capable of. So I'm incredibly excited.
I feel the same way as Mike. It's just an incredibly exciting moment. As Mike said, it's very cliche. You hear all the time that great companies are always started in these moments of downturn. And it's true. And I think there's some logistical reasons for it. It's, the 10% of people at big tech are getting laid off. And so there's more people on the sidelines with time at home to contemplate doing a startup. It also, to a degree, the barrier being a little bit higher to fundraise and things like that means that a lot of the signal to noise ratio is improved, that a lot of the posers and people that would sort of do this for the wrong reasons or without the requisite skill set are sort of washed away, and the people who are left are the people who are absolutely committed and talented irrespective of the external environment. So I'm really bullish on the moment. And also, as Mike said, just technology, if you look at what's happened in the last, just this summer with AI, generative image functionality from like DALL-E and large language models, like we are really in a moment right now where AI innovation is accelerating. And I think it's a moment that's similar to the advent of mobile computing or social computing. AI is very much going to change a lot, including in the health and medical space. And it's really, really an exciting moment to watch that speed of technological innovation accelerating. So I'm incredibly bullish as well.
Excellent. Anything else? No. Well, listen, Bradley, Michael, thank you for everything. I'm fortunate enough to get to spend an ample amount of time with these two guys pretty much every day. Somehow they let a schlep like me kind of hang around with them. But thank you for your insights. I always learn more every time I talk to you guys, and hopefully our audience did as well. So thanks, guys, and see you soon.
Thank you.
Thank you. I think everybody would agree that was a fascinating session, so thank you for leading those efforts. So for those of you at home and here, thank you for joining us today. This is the conclusion of all the scheduled programming. We encourage you to attend the networking reception for the opportunity to collaborate with the fellow attendees. If you're joining online, you can always interact with other participants online as well. Tomorrow, we have a very interesting lineup. We're going to concentrate a lot on brain tumors, both pediatric and adult brain tumors. And in addition, not only learning about how focused ultrasound can be applied to brain tumors for therapy, but also for diagnostic reasons with liquid biopsy. So that'll be an interesting session. We're also going to talk about chronic pain really interesting session on veterinary applications, and then in the afternoon, we'll finish up with an FDA town hall and capital markets. So it's going to be a fascinating day tomorrow. If you're staying on site, don't forget to pick up your ticket for the registration desk for complimentary parking in the garage. And thank you all for staying till the end of the day. I am sure you will agree that it was fascinating, and hopefully we'll see you next door in the networking reception. Thank you.